From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, December 18th. We're on the Macrocast. This is Tony Fratto with Hamilton Place Strategies. John Fagan and Brendan Walsh from Markets Policy Partners. The gang is back together. Guys, it's like, it's not February. It's not Groundhog Day yet. It's an early Groundhog Day. We're back talking about the stimulus bill again. More drama this week finally coming together. I would say, as we've said before, months probably late, given what we're seeing in the deterioration in the economy. But we've always felt like the running out of government money. The continuing resolution is going to expire on Saturday, plus the urgent need that we're seeing out there from people who are right in the crosshairs of this economy right now. So maybe something coming together below $1 trillion, somewhere between 900 and $1 trillion, probably is going to happen. This is Washington, so there's still things to debate going down to the wire, including one of the big wrenches in this, which we can talk about in a minute. But Senator Toomey wanting to inject into this a restriction on the Fed's 13.3 powers to support markets that came out of the original, or that was part of the original package of efforts to protect the economy back in the spring and summer. So we're looking at 600, very likely $600 per person in checks, probably some change, maybe some changes on eligibility there. They're still discussing eligibility. To me, a disappointing only 10 weeks of enhanced unemployment benefits, and those benefits would be $300 a week, which I think is fine, but the time frame is really too short for when anyone has any expectation for when the economy is going to get back on its feet in any normal way. As much as $330 billion for small businesses, including the about $250 billion, $260 billion for PPP. Again, some changes on eligibility there that they're playing with. Maybe you would have to demonstrate that your revenues are down by 25% in order to be eligible for those funds. Again, I don't think that is. I think that probably makes sense. Vaccine distribution money. Those are the big things. Lots of other cats and dogs in there. What's not going to be in there is big money for state and local.
And on that front, it's kind of been fascinating. The states, it's been a situation of haves and have-nots. A lot of states are reporting that their tax intake is up 5 to 6% over last year, to their shock. But there's a number of states, especially the states that are tourist dependent, like Florida, Nevada, Louisiana, and then the big states like New York that are really hurting, that need it. But it's not all 50 states that actually need it.
It's not. It's so that is one of the interesting things, right? You have uneven, kinds of economies. Yeah.
And even more ironic, the states that actually really need it are a lot of red states.
Right, and uneven taxing regimes in those states too, right? So the reason that one of the increase in revenues in those states are coming from sales taxes.
Yep, and especially online sales taxes.
And that was completely unexpected. I guess that a lot of them have increased costs also.
Yeah.
But how it all nets out is a state by state thing. I was trying to think of whether there was some kind of, and maybe it's something we'll get to think about in the new year if they come back to this, but some kind of way to model, to create a model that would work for most, if not all states. That might be a function of whether they've seen increased sales tax.
Yeah,
revenue.
just like you were saying for the small business, why can't you do a similar thing for the state? If you can show that the pandemic caused this hole and this much increase. Okay, we'll cover that, but we're not just going to give everybody, whatever, $5 billion.
Well, we're going to see. I mean, so the continuing resolution ends on Saturday. They're going to, maybe they're going to work through the weekend. We may see a brief shutdown, or we may see a brief, or we may see a brief, additional continuing resolution for a week, or right up to Christmas Eve, for them to get their work done. I can't help thinking, I think we're going to dive into like what this might mean going forward. But I just, John, you were talking about some of the data we've seen, and there is on the one hand, you look at this dance that we're going through right now, and it's perfectly normal. I mean, December's gone by. We've seen this dance where things, get to the wires. My friend, former business partner, Kevin Madden says, nothing gets to agreement more than the smell of jet fumes. Like those planes are, those airplanes that take these guys back home, right, are the thing. Once you can smell the jet fumes, they're like they want to get out and get on the airplane and get back home for the holidays. And so
your kids are waiting for you to bring the Christmas presents.
Yeah. Problem is that you can try to do this now, but like we needed Christmas in September. Like we're already late on this. And John, you were talking about some of the data out there that's causing worry right now.
Yeah, the backdrop to this negotiation is the data that has shown increasing evidence of deterioration over the past couple of weeks. That is not a big surprise, obviously, with the virulent resurgence of COVID and the selective tightening of various restrictions across the country in order to re-up containment measures. This week we saw retail sales and initial jobless claims. Brendan can give a little more of a deep dive into those, but those were both pretty meaningful disappointments for both, and both pretty meaningful numbers. These aren't, these are part of the, sort of crown jewels of the monthly economic releases that we get to give us a temperature on the U.S. economy, and both of them looked pretty dismal. So that's certainly one backdrop. The other backdrop that we have to these negotiations is the Georgia runoffs, and we can talk a little bit about that. There is a sense this week that Senate Majority Leader McConnell's pivot toward a more accepting stance of some of the higher numbers, the individual checks and so forth, which he had resisted before, might be driven by the political realities of what they're seeing in Georgia. That was a report from the New York Times earlier this week that I think the quote was on the call that the two GOP candidates in the Senate runoffs in Georgia are getting hammered on the issue of delay. We've obviously seen the House Speaker Pelosi and basically the Democratic leaders and the Republican leaders trying to trade blame for obstructionism. But it seems as though the calculus has shifted to some extent for Senate Majority Leader McConnell here. But that's not to diminish the economic impetus and the real world pain that we're seeing. Brendan, were the initial jobless claims and retail sales as bad as they looked on their face?
Yeah, especially this time of year where you usually have holiday, hiring and whatnot. So to have claims be going up is shocking. But over the last 2 weeks, we're up about 75,000, and most importantly, it's almost 900,000 people. But also when you tally it all up, so 1.3 million people either filed for new unemployment claims or their initial unemployment claims ran out, so they did the pandemic assistance fund. So that's 1.3 million. But then when you look deeper into the census release, there's 20 million people that are receiving some sort of federal assistance right now. That's the number that matters. And if we don't expand the relief bill, 12 million people will fall off and receive nothing. And that's on top of the 4.4 million people that already have exhausted their relief. So that, that's 16, 17 million people that are really, really hurting.
Makes you wonder, it's just this dynamic again, right? Like those numbers that you just ran through, like they're staggering numbers.
Staggering.
Right?
Yeah.
I mean, those are ridiculous numbers.
Yeah, we have about
3
300 million people. So you're talking, almost 10% of the population.
Yeah, I mean, on a normal good economy, normal economy that we've gotten used to over the past, 10 years,
Yep.
right? We basically had like a 10-year run of growth and job creation.
Amazing job creation. And beyond what the Fed thought. The unemployment rate kept going lower every month beyond what we thought was possible, really.
Right. And so like in those, on a normal week of initial claims is, somewhere between 200 and 300,000. I mean, yep. Across that entire time. And
that's what we had been for, 8 years.
Years.
Yeah.
Years of weekly claims. We are now weekly looking at 3 to 4 times those normal numbers. It's outrageous. And I think people have just become immune to it because, like the Dow's at 30,000.
Yeah.
And
the markets are, the tantalizing prospect of vaccine-driven recovery in 2021 is really keeping market spirits higher here. We saw a very modest, very limited reaction to these poor numbers that came out, and really that was because the ongoing story beside them, all the headlines were about Congress heading toward a larger stimulus bill this week. Yeah. The numbers looking larger. We'll talk more about the Fed upping their accommodative stance. And this is allowed market participants to look past what is potentially a double dip recession that we're staring into here, into the third quarter of next year, where everybody is excited about getting closer to normalcy, herd immunity, whatever it is, and that is really the aspect that is buoying spirits in the market.
And also that outlook is backed up by science. Dr. Fauci has given that kind of time frame. By the end of March, April, a normal person should be able to get the vaccine. So we should be looking at third quarter, a return to some sort of normalcy.
Yeah, I don't think the markets are wrong. I don't think they're wrong.
Exactly. Yeah.
I think their outlook is pretty bang on, right? I think second half of 2021, I think is going to be gangbusters.
Yep.
Right. I think it's going to be a great snapback, but no one was predicting. Like, just keeping back to this, like we did the CARES Act back in March, and if you had told those guys that we're going to have, 900,000 people filing for unemployment, 1.4 million people filing for unemployment insurance in December, we would have passed, support a long time ago. Like no one was predicting this. No one was predicting 20 million people on federal assistance. Nobody was predicting lines at food pantries. This is, we could see the end. So the market is saying like, we see the end. It's like, yeah, we all see the end. Mm-hmm. What we need is for everyone to get there, and this is like, a lot of people are not going to get there without, tumbling into, other forms of federal assistance. And they're going to tumble in there the hard way, not ease their way in. And look, this bill is going to help. There's no question about it. Like this bill is going to be helped. The market should be, buoyed by the fact that something is going to get done here. I don't want to.
You are confident that we get something?
Yeah, I'm confident that we're going to get something.
I think you're right. Yeah.
Yeah, I think we're confident we're going to get something. I don't, the politics of it. Our friend Ben White from Politico, he and I were exchanging about this yesterday. Just baffling on the politics on this as to why, Trump and Republicans were not pushing for a deal back in March. And the only thing I can think of is that they didn't want to hand that a big pot of money to the Biden administration. It's the only thing I can think of, because as you just said, John, like I don't, if for my career I had only said, whatever Mitch McConnell said the political outcome is going to be, if I just said that's what the political outcome is going to be, people would have thought I'm really smart and right for a long time, because he's usually right? He has control over his caucus and he usually sees it right. I don't know whether that story about, that they're thinking about checks is because of, Georgia. I don't know whether that's true or not. I'm just saying they got the politics very wrong on this one. CARES Act was popular. Support for the economy would have helped Republicans. And I don't care about the politics. I'm just saying it's obvious it would have helped Republicans.
I fully agree.
Yeah, it would have helped Trump in a number of states. And I don't think they'd be looking at a runoff in Georgia had they had done these things. So they got the politics wrong. What's more concerning for me is they're getting the economics wrong. Like they got the economics wrong. There's a lot of pain for a lot of businesses and companies. And I will say, it's like people get itchy about saying things like this. A lot of lives are lost because they got both the politics and the economics wrong here. Like I think we would be in a better position right now, people willing to isolate, people willing to, do the things that the CDC is saying to do to stay safe, if they were getting cash assistance to incentivize them to do that. So it's not like wild to say that lives have been lost because we have failed to do this. I think lives, in fact, have been lost. Businesses have been lost. Jobs have been lost. So this is, bad economics is never good politics. And I think they may be finding that out here. We'll see. When we come back, there's other stuff. So I want to talk about the Fed and what they're seeing. We're going to squeeze Brexit in today, aren't we? Like we have to.
Oh, we'll have time. Well, they're going to keep the deadline until the 31st.
How do you have an oldie but goodie Brexit on this? All right, we'll come back. We'll come back and maybe get into both of those, but at least the Fed. You're listening to the HPS Macrocast.
Markets Policy Partners provides sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com or visit them on Twitter @marketspolicy.
And we're back on the Macrocast. Tony Fratto here with Hamilton Place Strategies, Brendan Walsh, John Fagan from Markets Policy Partners. We had an FOMC meeting this week. Got to hear from Chairman Powell at his presser. How are you guys seeing where the Fed is right now? I mean, this was a little bit newsy, wasn't it?
It was indeed. Yeah, it was expected to be a meeting in which the Fed pivoted toward their asset purchase program. We saw back in September, there was that reassessment of their inflation and full employment targets, very consequential changes in the dovish direction, making that average inflation targeting with some fogginess around the definition, but adding a lot more upside potential to their inflation formulations there, a much more permissive stance toward that, and in September also redefining to some extent their mandate on full employment to emphasize lower income groups. And that is particularly salient these days as lower income groups have been absolutely hammered, disproportionately hammered by the pandemic here. So that's certainly in line with the economic realities that the Fed is facing and trying to mitigate here. This was at the time, one of the big questions was they've made their targets more ambitious, but why aren't they doing more vigorous accommodation in an effort to hit those targets more swiftly? And that was kind of the question that people expected to have answered at this meeting. And there were signals coming in through the minutes and other statements from FOMC members that the asset purchase program would be the main lever that they would use to apply additional forcefulness to their accommodation. So drum roll, please. We go into the meeting and analysts are kind of putting their bets on the table. There was an expectation that the Fed might increase the weighted average maturity of the treasuries that they're purchasing. This is what they call the WAM, the weighted average maturity. I think it's always a minefield talking about WAM around Christmas because last Christmas starts going into your head and it's sorry, WAM reference. But
okay, come on, that's pretty good. I got it. was great.
Anyway, I won't sing a few bars of it, but I won't. I'll refrain from that. But there was a sense that they would dial up the accommodation by increasing the maturity of their purchases, and that is something that's maybe a little less overt than one of the other options, which would be just increase the size of it. They're doing 120, and 80 of that is treasuries per month, 120 billion. There is a sense that they could also increase that. What they didn't do at the end of the day, they didn't do either of those. They instead went with an outcome-based guidance for the current program, which was that they intend to maintain asset purchases at this level until there was meaningful progress toward their mandated goals of maximum employment and stable inflation. What exactly those benchmarks would be were left undefined, very foggy. There was a sense initially in the markets that this was a little disappointing. There was kind of hope that we would get this sugar rush before the holidays, right? An added increase in purchases or duration upsizing. But instead of a sprint, they went for what looks more like a marathon here. And that initial disappointment, once traders started to do the math, they thought to themselves, this could very easily resolve in a larger balance sheet ultimately down the road than might have occurred if you'd taken the sort of additional burst of QE right up front here and then signal that you might start tapering later in the year. And so now this is a real set it and forget it kind of moment, just like they've done with rates. Yeah. And that has added an enormous amount of certainty into the market for the coming year. Clearly, we don't know where their benchmarks are for substantial progress. That's going to be a communications challenge for the Fed coming up this year. But what we can all say right now is that they're probably nowhere near any of those benchmarks right now. So if
those benchmarks, if we're talking about those benchmarks tied to employment, we're a long way, right?
Yeah.
Right. We're disconnected, somewhat, because it would be a Christmas miracle if we saw sufficient inflation, but and I mean like Christmas 2021, not this Christmas, right? Like we're like a long way from that, and we're a long way from meaningful improvement in the employment situation. I mean, it's going to come. Like I said, I'm optimistic about the back half of 2021, but not to reach the kinds of levels that they're talking about if they are talking about wage gains at the bottom, especially.
And I don't think you can understate how important the Powell Fed has really changed and expanded the mandate of the Fed, as much so as probably anybody since Volcker. And I don't know if it's ironic, but I think Powell, when he took the job, thought he might have a nice kind of boring run where he'll slowly normalize policy and then retire. And the exact opposite has happened. He's faced crises and he really has massively expanded the Fed's monetary policy mandate.
I think you bring up a very important point with that normalization. We all remember way back, even at Bernanke, in the taper tantrum, whenever he was doing the policy QE 1, 2, 3, all of those policies that he pioneered to pull the global financial system back from the brink of disaster in 2008, 2009, there was always a sense that these were emergency settings and that we would be going back to normal at some point in the future. And when Yellen was chair, that was certainly her direction. There was a clear impetus and yearning almost among the FOMC members to get back to normal, to start normalizing policy, to get back to the kinds of rates that we associate with a healthy economy and so forth, and extract ourselves from these emergency settings. It's obviously a big challenge. And when she was incredibly deft at communicating with the markets to try to soften that process and make it palatable for markets that have been really, addicted to low interest rates and stimulus. And I think that we've seen.
It's also kind of ironic that the market views her as the biggest dove in the history of the world, and she's the only one that was able to raise rates.
Yes, a total misperception. But that doesn't mean she's not pro-growth. She's obviously very pro-growth. But when you look at what the big watershed that we see is in late 2018, when the Powell Fed got way overcommitted to its tightening cycle and ended up in a disorderly retreat into easing in the early part of 2019. That was when it seems to us that the concept of normalization really evaporated. And you don't see that you certainly don't pick up that signal from the current Fed board that they're trying to get back to normal. There's sort of an acceptance that this is kind of, this is kind of normal. And that the policy settings that they've put in place, this zero interest rates, as far as the eye can see, quantitative easing, basically set on a very similar trajectory. Just set it and forget it. It's going. This is this is the normal. This is normal.
Where do you see? I mean, of the other major central banks, do you see? Are we seeing movement from them in a similar way? Like, do you see ECB moving in this direction?
Oh yeah, the ECB is very aggressive as well. They certainly haven't let themselves be, significantly outdoved by the Fed. There's a lot of currency. It's not currency war, but it's sort of currency. That's definitely a factor, and the ECB has expanded their mandate in ways that the Fed has not. At least not in the sort of normal course of business, the corporate bond purchases and so forth. We've obviously seen the Bank of Japan pioneer a lot of very aggressive monetary strategies. And overnight, in their decision this week, Governor Kuroda announced that they were going to be performing a 3-month review of their easing policies, particularly yield curve control and their asset purchases. And this is not it's pretty clear that they're not doing this in an effort to, set up some sort of taper. They're looking for how to juice these programs even further. So that is going to be one to watch. They're already buying enormous amounts of equities through ETFs, and they've got negative interest rates. This morning, a Bank of England official mentioned that the Bank of England might need negative interest rates in order to get through the economic winter that we're seeing here. The Fed looks, the Fed doesn't look particularly extreme against its peers.
It really doesn't. That's why I asked the question. It's it's like we are sort of seeing it coming into line with the major central banks around the world.
And both of those central banks are encouraging fiscal expansion. So very interesting.
That's a great point.
When Powell was encouraging us to pass a large stimulus bill. And what he said is, when you look at our debt nominally, it's large. But when you look at it in terms of cost of debt service, it's actually below historical average. So he says we can afford to spend a couple $1 trillion to help us get through this, and it'll be positive in the end.
Yeah, and look,
but that's changing the way that we spend our money
And Japan, which carries a much larger sovereign debt burden as a percentage of GDP than the U.S. does, way far out ahead of where we are, and has been for years. This has been a subject of macroeconomist consternation for a long period of time that Japan should be running into terrible debt problems. They just passed an enormous fiscal stimulus bill. Abe's protege, who just took over as prime minister, is trying to put his stamp on the economic policies of Japan. And this big stimulus bill, they passed it, and their markets didn't. There wasn't even a flutter in their bond market. They had
that's been the joke in financial markets, that the shorting JGBs has been the widowmaker for every macro trader's career.
For sure.
Yeah,
right?
People gave that up in the early 2000s. It just wasn't working.
Yeah. Look, I think there's if you think about economic policy mistakes, I think there's a strong case to be made that we have underinvested because we have we had this fear of borrowings, not just the austerity. Austerity is a thing also, and the sort of balanced budget nuts out there. But there was this, this story that, like, you're going to saturate the market and rates are going to spike and you're going to lower growth for everybody because, we'll be faced with higher interest rates and stuck, governments are going to be stuck with this ability to roll over debt, with the cost of that ever increasing. So there's a story that we all told each other. what we found out, what we have discovered now is that it's just not true, right?
Yeah.
Or at least
every time we go through some sort of crisis.
Yeah, I don't deny that
Treasury rates go down.
Yeah, I'm not a modern monetary theorist. I'm not on that bandwagon. I'm just saying that like that theoretical limit is like way further out than anybody presumed, and so what has that meant is that like we missed an opportunity to invest in things that would have generated high productivity returns. Now, maybe we still have that opportunity. The problem is we faced with this crisis and we've spent a couple $1 trillion on consumption. We've had needed to. It's the right thing to do. So have we gotten closer to that theoretical bound? I don't think so. I think we're still like, trillions of dollars, tens of trillions of dollars away from that theoretical boundary. But there are people who are trying to make that case. And I think that's the fight that we're going to be talking about a lot in 2021 is like, the people talking again about, well, we don't want to test that bound because if rates go up, it's going to cost and lower growth. But like I said, I would have loved to have seen a couple $1 trillion over the past 20 years invested in infrastructure and education and healthcare, and this country would be way better off than it is today had we.
And those are the kind of investments that have a return
forever.
Forever.
The returns are forever.
Yeah.
Right.
You get your money back.
You get your money back many times over when you invest in those things. So maybe we'll do that. Maybe we'll get a chance to do that. And regardless of who's control it, that's not the point, right? I think like there are opportunities to invest in those areas that will improve the country over time and improve growth and standards of living over time. Hey, why don't we take a quick break here? We'll come back, take a look at next week, and see what there is for us to worry about next week. You're listening to the Macrocast.
Every 2 weeks, HPS measures U.S. adults' feelings and expectations for the economy. The HPS Civic Science Economic Sentiment Index accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us through HamiltonPlaceStrategies.com.
All right, we're back on the Macrocast. It's I'm so excited. It's just like give me a hit, give me a Brexit hit, right? Like as we're in the last week of is there going to be a deal, no deal, what's a deal going to look like? I need a hit, I need a fix, I need a Brexit fix.
Well, yeah, this is probably the 8th make or break weekend. This is the real final deadline for sure. Absolutely, pinky promise. The European Parliament isn't going to be able to ratify any deal that isn't agreed by Sunday, right? So This Sunday, this is the real deadline. So this is another one that they can blow right through probably. There were some positive indications earlier this week, a sense that the UK and EU had ironed out some problems that they have over the level playing field, so to speak, issue of state subsidies, but there was some crosstalk about how resolved really was that, but it still seemed pretty clear that the fishing rights aspect remains intractable. The two are still at loggerheads over that. The markets don't seem to believe the dire commentary coming out of Boris Johnson, Prime Minister Johnson and his team, or the Europeans. The markets are basically betting that some kind of deal is going to happen. And even if no deal happens, it'll be an amicable Brexit where they continue to talk into the new year. So it's almost like this. They've blown through every other deadline. Why not blow through the official deadline? That sort of posture softens the blow in the markets, but not necessarily in the economy. In the real economy, there's going to be something that looks a whole lot more disorderly for a period of time if they don't come up with something this weekend. So
my favorite is Boris keeps saying, well, we might have to do the Australia deal, which means you don't have a deal and you just do the WTO rule.
Right. It's like, look, come on, this is great. I mean, this is, we're going to get a season 6 of Brexit, which is great. The
The Queen's
Gambit. I was worried that they were. Yeah, I was worried that it was. We weren't going to get. We weren't going to get a new season. We're going to be able to stream a new season of Brexit, and so it's great. 2021 will be fun. We'll be talking about it here on the Macrocast again.
Yeah, it's exactly the opposite of the Queen's Gambit. Instead of geniuses playing chess, it's fools playing checkers.
Hey, do we have any data next week worth paying attention to during the holiday season?
Very quiet. So we will get the final estimate for third quarter GDP. So second quarter is when we went down 30%. Third quarter is when we went back up 30%. Fourth quarter is not looking so great. And then we also get personal income and spending, which that will be an important data point. And also within that report, we get the PCE price index. That's the inflation gauge that the Fed likes to focus on. Which is
these are. I mean, just getting a read on where consumers are right now, I think is really important. I think maybe this is a thing that's surprising people. It shouldn't be, but it is, and we'll pay attention to that. Guys, thanks for a great Macrocast. Have a great weekend. We'll talk again next week.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.